Gold just did something that has never happened in modern market history. It rallied harder, faster, and higher than almost any asset on Earth. And then, in the space of a few months, it gave back nearly a third of that move. Silver did the same thing, only worse. And underneath both of those crashes, the actual physical shortage of the metal got worse, not better. That gap between a price that's falling and a shortage that's deepening is the untold story right now. Stick with me, because by the end of this video, you'll understand exactly why that gap exists, what the world's biggest banks are actually fighting about behind closed doors, and what it means for anyone holding gold or silver right now. Here's the belief almost everyone holds right now, and it's an understandable one. Gold and silver had their moment in January. They've been sliding for months, so the story is over. Cash in, move on. If you've been watching the price bleed lower since the start of the year, that reaction makes total sense. But here's the part almost nobody is saying out loud. The crash and the shortage are two completely different stories, and right now they're moving in opposite directions. Gold touched an all-time high near $5,600 an ounce on January 29th of this year. Today it's trading in the low $4,000, down more than a quarter from that peak. Silver hit its own record above $121 an ounce that same week. Today it's trading somewhere in the 70s, down over a third. That's the price. But the physical market underneath it tells a completely different story, and that's what nobody's explaining properly. Body point 1. The supply fight nobody's resolved. Context. Let's start with gold, because there's an actual disagreement happening between two of the most respected sources in the industry, and it matters more than any single price target. Application. S&P Global put out a forecast that gold mine production peaks this year, 2026, at around 110 million ounces, and then starts declining, down to roughly 103 million ounces by 2028. Their reasoning. The easy, high-grade deposits near the surface have mostly been found, new discoveries have gotten smaller and rarer, and it takes a decade or more to bring a brand new mine from discovery into production. So even a major find today wouldn't add supply until the mid-2030s. Here's the twist almost nobody covers. The World Gold Council looked at the same data and pushed back. Their view is that production is more likely to plateau than to fall off a cliff. They point out that 2025 was actually a record year for mined gold, and that output has stayed remarkably stable, moving by only 2 or 3% a year for 2 decades. Two respected institutions, same underlying numbers, genuinely different conclusions. Framing. Why does that disagreement matter to you? Because it tells you the running out of gold narrative you've probably heard from other channels isn't settled science. It's a real live argument inside the industry. Anyone presenting peak gold as a locked-in certainty is skipping half the story. The honest version is messier, but it's also more useful. Supply growth is clearly slowing down. That part both sides agree on. Whether it turns into an outright decline is the open question. That's gold. Silver's story is different, and in some ways more extreme, because unlike gold, silver's shortage isn't a forecast. It's already happened, 6 years running. Body point 2, silver's 6th straight deficit. Context. According to the Silver Institute's World Silver Survey, 2026 marks the 6th consecutive year that the world has used more silver than it has mined. This year's shortfall is projected at 46.3 million ounces, added up since 2021, and the market has drawn down about 762 million ounces from above-ground stockpiles, vault holdings, dealer inventory, exchange reserves, just to cover the gap. Application. Here's the mechanical reason this is so hard to fix. Roughly 70% of the world's silver doesn't come from silver mines at all. It comes out of the ground as a byproduct of mining copper, zinc, and lead. That means even when silver prices spike, miners can't simply produce more. Output is tied to decisions being made about entirely different metals. Meanwhile, more than half of all silver gets consumed by industry. Solar panels, electronics, EV components, and increasingly AI data center hardware. And once it's used, most of it doesn't come back into circulation. Framing. This is why silver's price crash and its supply crisis aren't contradictions. They're just running on different clocks. The price responds in hours to interest rate expectations and trader positioning. The deficit responds over years to mine economics that don't move quickly no matter what the price does. 6 straight years of drawing down stockpiles that took decades to build up is not a small thing, even while the chart looks ugly week to week. Now here's where it gets genuinely useful, because this next part is the piece your other sources probably won't show you. What happens when you put the actual forecasts from major banks side by side? Body point 3. Why the forecasts disagree so wildly. Context. If you've watched enough of these videos, you've heard price targets thrown around like they're settled facts. They're not. Here's what's actually on the table right now, from real institutions as of this summer. Application. On silver, JP Morgan's 2026 base case sits around $81 an ounce. Bank of America has been more conservative on its base case, but has floated a bullish scenario as high as $309 if the deficit keeps widening sharply. Worth noting, that's a stress test scenario, not a forecast anyone's betting the house on. ING actually cut its estimates this year, down to $68 for the third quarter and $74 for the fourth. And UBS did something that got almost no coverage outside specialist trading circles. They slashed their deficit estimate for the year from roughly 300 million ounces down to 60 to 70 million, because they saw weaker solar demand and softer investment buying than expected. Framing. Notice what just happened there. In the space of one paragraph, you saw a bank go bullish, a bank go bearish, and a bank cut its own shortage estimate by more than 3/4. That's not indecision. That's what an honest market actually looks like when nobody has perfect information. The lesson isn't which bank is right. It's that any video telling you a single number with total confidence is skipping the part where even JP Morgan and UBS can't agree. On the central bank side, the buying story is real, but it's not as clean as it's usually presented either. The World Gold Council still expects central banks to buy somewhere in the 700 to 900 ton range this year, similar to the past few years, and Goldman Sachs actually raised its estimate of how much central banks are buying after finding gaps in the trade data. But it's not one-directional. Earlier this year, Russia's central bank was reported selling gold to help fund its own budget needs, and Poland's central bank governor publicly floated selling reserves for a profit before buying back later, which set off a political fight at home. Central banks are, on net, still buyers. But still, buyers on net and everyone is buying no matter what are two different claims, and only one of them is true. Body point 4. What's actually moving the price right now? Context. So if the shortage is real and the central banks are mostly still buying, why has the price fallen so much this year? Application. The short-term answer is interest rates and geopolitics, not the metal itself. The Federal Reserve under Chair Kevin Warsh has held a hawkish stance, and several officials have pushed for further tightening rather than cuts. Higher rates make non-yielding assets like gold and silver less attractive compared to bonds that actually pay interest. On top of that, renewed U.S.-Iran tensions have kept energy prices elevated, which feeds inflation fears and, in a roundabout way, reinforces the case for the Fed to stay tight rather than ease. That combination, a hawkish Fed plus an unresolved conflict, is what's been pressing the price down since the January peak. Framing. This is the piece that ties the whole video together. The price is being driven by a short-term, fast-moving story, rates and geopolitics. The supply side is being driven by a slow-moving structural story, mine economics, byproduct constraints, discovery timelines. Those two stories are operating on completely different timelines, and right now they're pointing in different directions. That's not a contradiction to be scared of or excited about. It's just what a real market looks like when you stop flattening it into a single headline. So let's pull it together. Gold and silver both fell hard from the January records. Gold down roughly 1/4, silver down over 1/3. At the same time, silver just logged its 6th straight annual supply deficit. Gold's long-term supply outlook is genuinely disputed between S&P Global and the World Gold Council, and central banks remain net buyers, even though a few, like Russia this year, have been selling. The forecasts from major banks range from $68 silver to $309 silver, depending who you ask, which tells you more about the uncertainty in the market than any single number could. I'm not going to tell you what to do with that information. That's not my job. And honestly, anyone who tells you with total certainty what gold or silver will do next isn't being straight with you. What I can tell you is that the two stories, the falling price and the deepening shortage, are both true at the same time, and now you understand why. If you want to actually stress test this yourself, which side of the peak gold debate do you find more convincing? S&P Global's peak and decline call or the World Gold Council's plateau argument? Drop your take in the comments. I read all of them. And if this was the first video that actually showed you both sides instead of just picking the scary one, subscribe, because this story is going to keep developing, and I'll keep bringing you the version that doesn't leave half of it out.